Good morning and welcome to this Monday, May 22nd, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, currently, we did close out options expiration week last week, and I thought it was pretty surprising how the market performed given so many in-the-money calls. But I think that just kind of shows the level of bullishness that the market is at now. Looking at futures, we got a little bit of a mixed bag, but mostly pretty flat. Dow futures up 10, S&P 500 futures up about a quarter, NASDAQ futures down 8. So a little bifurcated action, but pretty much all of the major indices near the zero line. Crude oil prices down just fractionally, still just hovering above $71 a barrel. Big news, 10-year Treasury yield has been climbing and is currently just above 3.7%. I think this is a big level. There's a gap resistance right at about 370. Recent highs on the yield have been about 365. So this is kind of a key area in the short term. There were a couple of things that really surprised me about last week's advance. Number one, the 10-year Treasury yield climbing throughout the week. And then number two, the options expiring and having so many in-the-money calls on many of the aggressive growth stocks, and the fact that they continued to lead last week. That's unusual. We don't normally see that during option expiration week, and I was even a little bit cautious going into the week because of that. But the market, I think, is proving its mettle on the bullish side, and I think we're going to continue to see higher prices. Now, obviously, we're getting overbought. The market's going to see a pullback at some point. But and for me, I'm kind of watching maybe the 60-minute charts. I think if we do break out again on the NASDAQ, for instance, it looks to me like there'll be a negative divergence. We'll look at that or try to look at that a little bit later in the show. But overall, I mean, it's hard to argue. Been talking bullishly about this market since back in June of last year. Nobody wanted to talk bullishly then. Tried to talk about all the manipulation that was taking place. A lot of bears thought, oh, you know, he's just a perma bull, ignore him. It's turned out to be exactly right. There was a lot of manipulation. If you look at the intraday action during various periods over the last 12 months, well, actually maybe even 18 months, and I wrote an article over at Stock Charts. If you haven't seen it, you'll definitely want to check that out. But, you know, it just looks to me like the market was being accumulated throughout the summer. And so, you know, we can sugarcoat it, or we can gloss over it, or we can pay attention to it. And I chose the latter. When I see the big Wall Street firms doing what appears to me to be major accumulation, I'm not shorting the market anymore. That's what they want. They want the sellers. They want the fear. They want that panic. They want that opening gap down. They want the selling in the morning. Why? Well, unless you like to pay higher prices, it's pretty obvious. They want lower prices. You know, the biggest, and I'm going to pull my charts up here in just a second, but I just want to make this last point. Many of you know this. I've talked about it many times, but there's one of the biggest conflicts of interest I've ever seen is the fact that Wall Street firms, these big firms, can buy on their own behalf. They can buy for their wealthy clients. That's step one. Step two, they can send out their analysts, I call them influencers, to parade out onto CNBC or wherever, telling everyone else what to buy and what to sell. Wouldn't you like to do that? Wouldn't you like to buy in your own portfolio and then go out and tell the public what they should be buying or selling? Doesn't that by itself already seem to be somewhat of a conflict of interest? But then throw in the third step, where after they tell us what to buy or sell, they have market making units back at their firms that profit from trading the opposite of what they're telling us to do. Does that not make you want to shake your head and maybe even get sick? They have huge advantages over us. They see all the order flow. They know the history. They know the amount of money that's going to be coming into the market, beginning of the month, middle of the month, 401ks, pensions. They have so many advantages. We got a lot of information that we never used to have. So the playing field has leveled somewhat, but it is still way skewed toward Wall Street. And you have to be aware of the way this system works if you're going to be a trader. And so it's that conflict of interest. It's that market maker behavior, that Wall Street firm behavior that makes me do the research I do, to look, to follow what's going on under the surface throughout the trading day. I mean, since the pandemic began, the AD line has been the savior for me in the stock market. And what I did on an intraday basis was really just an extension, additional research into essentially the AD line. Looking intraday, ignoring gaps. That's what the AD line does, the accumulation distribution line. I'm not talking about advanced decline. Some people, when I say AD line, they're thinking advanced decline. It confuses them. I'm talking about accumulation distribution line. It was developed by Mark Chaikin. I think it's brilliant. And I think there's certain markets it's going to be more impactful than others. I think when you're heading into a bear market, I think it gives you great clues. I think when you're coming out of a bear market, it gives you great clues. I think as we go forward, it's probably going to give us less clues. Honestly, the AD line might not even be a big part of what I look at going forward. Anyway, that's what I'm seeing. I do want to just start off here, though, with showing you an article I wrote over at Stock Charts. Please go check this out. I was calling it Wall Street's Hunger Games. Just a little play on words there more than anything else. But essentially, this chart is the one that I featured over there. And it shows from back November of 2021 through where we are right now. And these different phases that we went through based on intraday trading. Now, if you look, the pure distribution phase is down. And then we actually went lower 2 more times. And yet I'm calling this the bullish manipulation phase. If you just looked at the technicals, you'd say, hey, we were going down. We continued to go down. What's up with this? How can you call this bullish? Well, I can't just looking at the action, but I can by looking at the intraday and what was going on. We were seeing continuation of gap downs and early morning selling, but instead of late morning selling and afternoon selling, like we had seen in this phase, we saw massive buying after 11 a.m. in the morning throughout this period. So you look at it and it doesn't look any different. But if you do a little research or you follow us at Earnings Beats, you'd know it was a lot different. Money was beginning to change hands and moving back into Wall Street's hands on a long basis. They were going long. When everybody wants to sell and we have this bear market and everybody's bearish, it's really easy to accumulate shares because everybody's selling. So fine, go ahead. Send out our influencers. Things are horrible, folks. We get the gap downs. And then, of course, all the bears that are out there thinking this thing's going straight down. It's going to be Armageddon, Great Depression 2.0. They're selling at the open. This thing can't go anywhere but down. Just a year earlier, it couldn't go anywhere but up. But now it can't go anywhere but down. And then Wall Street was just quietly buying and buying and buying throughout this entire period. And now we are seeing what happens when Wall Street has accumulated all the shares they need. And all of the retail traders are sold out. I mean, let's face it. If you've been bearish, what have you been doing? You've been selling, haven't you? I know a lot of people sitting in cash. They're not going to get in until the market hits bottom. They're sold out. They've sold everything. They're in cash. Lots of people shorting. Lots of short interest out there. We're to the point where there's no more selling left. And so this is the result right here. And it's been fun to be long. But you had to look under the surface. You couldn't look at the technicals. I'm going to talk about this later, but we finally took out that August high on the QQQ. All right. I kind of skipped over some things, but I really felt like that's important. Go over to stock charts, click on the articles, make sure you check out my Wall Street Hunger Games article. Anyhow, looking at the action from Friday, let's go back now. Dow Jones Industrial Average was down 109 points. S&P was down 6. NASDAQ was down 31. Mid caps down 22. Small caps down 8. Across the board selling. I really expected a little bit more of this. I'll be honest, I'm surprised we broke out last week. There was just so much. Now, I wasn't shorting. I didn't think that, well, actually, I shouldn't say that. I did have a couple of individual stocks that I shorted, and it didn't work out very well. Got out very quickly. But what I said was, I'm not going to short the overall market because I believe we're in a renewed bull market. And the worst thing for me personally is to short a market that's going higher and that I said would go higher. I mean, think about that. If you call the market to go higher, what's worse than losing money on a short? I just don't short. That's the reason why people say, why do you call tops and bottoms? What's the point? It's worthless. Well, if you followed us for the last 18 months, I think by now you know it's not worthless. When I call a top, I change my trading strategy. That's why it's important for me to see a top. I no longer trade by bull market rules. I trade by bear market rules. So if I'm going to do anything trading wise, I'm generally going to trade on the short side into strength. When we're in a bull market, I try to buy into weakness. It's the exact opposite. One problem with most traders is they try to trade every market the same. They either always want to short, they always want to go long, and they're, in a bear market, they're trying to buy into pullbacks. Well, the problem is the pullbacks don't end. They may temporarily suspend while the market bounces a little bit, and then they go to new lows. And that continues until you see a bottom. And then actually you start to show higher highs and higher lows. That's the importance of calling tops and bottoms. My trading strategy changes. So once I called the bottom, I stopped shorting. It didn't mean I was 100% long from the very beginning. Actually, I was in June of 2022. But there were periods after that where I'd wind down a little bit. Other periods I'd go long with leverage. January was a great market for leverage to the upside. I mean, it went straight up. Last month or so has been pretty strong time to be. I mean, you can just look at the S&P 500 off the low in March, actually last 2 months. Look at the NASDAQ. I mean, that's when you want to be thinking leverage. Here's January. That's when you want to be thinking leverage. Now, jumping into leverage right now, I personally think is a mistake just because we're extended. I'm just going to be in long into something like the QQQ, maybe a couple individual stocks. That's my strategy. And if we pull back near the 20-day, I'll get out of some of my QQQ and I'll jump into either the QLD or the TQQQ, which is the 2 times the NASDAQ 100 or the 3 times the NASDAQ 100. It's leverage. So I welcome selling because I'm going to start building a leverage position because I believe we're going higher. So if you're going to give me cheaper prices, I'm going to start building leverage. We're going to keep going higher and be overextended. I'll just ride the market up. Take your pick. I don't care. But I've been convinced we're going higher. I say it on here every show. I write about it over at Stock Charts. Our members at Earnings Beats know it. I write a daily market report to our members. I'm bullish. I'm as bullish as it gets. And I think we're going not a little bit higher. I think we're going a lot higher. Like way beyond, I mean, I'm talking about the next several years, way beyond all-time highs that are currently out there. Way beyond. You want to go out 3, 4, 5 years? I'd go S&P 500, 8,000. I mean, since you already think I'm crazy, how about a double on the S&P 500 in the next 4 or 5 years? That's what I see. Anyhow, and, we'll have signals along the way. There may be another cyclical bear market that we'll have to be aware of. But I don't understand why anybody's perma bear unless, I just don't understand it. Look at the long-term chart. Market goes up a lot more than it goes down. So you definitely want to lean to the bullish side. And then when the signals tell you, take your foot off the gas. Start shorting if you want. Hit the brakes. But right now, signals to me point straight up. Sectors last week, energy was the biggest mover on Friday to the upside. Healthcare second, materials third. That's a little bit of what I expected throughout the week, because these are three underperforming groups. And normally, option expiration week is what I call opposite George week. And whatever's not working tends to work. Well, it didn't really work until the end of the week. And we started to see a little bit of strength and we may see more of that this week. A lot of times option expiration will carry into the first 2 or 3 days the following week. That's been the history of the market. So I wouldn't be surprised to see money rotating into those areas and away from the areas that struggled on Friday. Discretionary, which has been performing very well of late. Communication services, here's your leader for 2023. They finally pulled back on Friday, and I wouldn't be surprised to see some selling in those areas, because anybody who was holding in the money calls last week, if they want to avoid taxes, they can just jump into the stocks or ETFs that they had calls on. Just exercise at their strike price. And when they do that, market makers are on the short side. So as you go into the week following expiration week, market makers still have incentive to bring prices down. That's why that option related selling can go into the next week, because of the ability of individual traders to exercise their options. Let's move on. So the 10-year Treasury yield. This was another head scratcher for me last week. I mean, look at the 10-year Treasury yield's been going up now for about 6-7 straight days. Let's get an update here. Right now, 3.69%. So it's down just slightly from where we finished on Friday, but we're in an uptrend. We cleared both of these tops. And there's your gap resistance I was talking about at 370. So we went right up to there. So is this slight breakout above these tops, is this going to be similar to what we saw right about in here, where we had tops of 390, went up to 410, and then went back down? I don't know. But I think you have to respect this uptrend until it reverses. And as yields go higher, I would think that would play into the selling of some of the growth stocks, especially because we've been so extended. But it didn't happen last week. While the yield was going up, so too were all the growth stocks throughout most of the week until, like I said, maybe on Friday, took a little pause. So this is going to be something to continue watching. I think it would be a little baffling if yields just kept going up, went back up to 410, and the stock market kept going up with it. I mean, historically, that's not that unusual. Folks move from bonds into stocks when they're reallocating. And when they do that, when you move out of bonds, you sell bonds, yields go up. And then when you move into the stocks go up. So it's not unusual historically to see the two move together. But because yields and the direction of the yields has had such a inverse impact on stocks throughout the last few years, I mean, maybe we're going back to the norm. I don't know. But my guess is we're going to see rates lower. That's still what I'm looking for. So continue to watch this. Not only watch what's going on, but if it keeps going up, watch to see what is happening in terms of like the QQQ relative to the S&P 500. That'll be an important relationship to watch. All right, let's talk a little bit about the S&P 500. By the way, news this week, economic news and earnings news. Earnings news is going to slow. We'll have some retailers reporting. But economic news, today we have nothing but Fed speak. So James Bullard talks at 8:30. Thomas Barkin is at 10:50. Mary Daly's at 11:05. So there might be some reaction during the day just based on what someone from the Fed might be saying. But otherwise, there's no economic reports. Later this week, tomorrow, we get new home sales. Wednesday, FOMC minutes. So we'll get the minutes from the last Fed meeting. Thursday, the GDP second estimate. So we've already had the first one, which I think is the biggest one. Unless there's a major revision, I don't think that one will be that big. And then Friday, we have personal spending and income. And of course, that comes with the PCE price index, which is one of those inflation indicators that the Fed keeps an eye on. So that's what we got later this week. But today, really not much. And so we'll see how the market trades off that. So looking at the S&P 500 right now, here was a big breakout on Friday or Thursday of last week. And Friday, we held above the 4179. So we went up. I think we closed at 41.98. Yesterday we closed at 41.91 or almost 41.92. Still above. I mean, I think one of two things. I think we either continue moving higher up toward 4,300, which is 43.05 is the major close that we need to watch. This is a major price resistance level on the weekly chart. I'll show you that right here. So here on the weekly chart, lower low, lower high, lower low, lower high, lower low, and that's it. Everything in between has been between this lower high and this lower low. So, and that number right there on a daily basis, we go back to the daily chart, is at 43.05. That's the number right there. So this, I think, was a big breakout. It was a significant short-term breakout. I think from a more intermediate, even longer-term perspective, 43.05, watch that one on the S&P. I think it's going. And the reason I think it's going is because we've already seen the NASDAQ 100 breakout. But I want to take you back because on this S&P, as we move higher, I want you to look at what's going on under the surface with the three major aggressive sectors. XLK versus the S&P 500 is soaring. It's leading. You've got technology and communication services that are leading the S&P 500 higher. That is historically a very, very bullish signal. It's telling us that this move to the upside is quite sustainable because we're in a risk-on market environment. XLY versus S&P, you might look at this and say, well, it's not, this one's going up to, had a high in August, had another high in March, and now new high now. This is the opposite. We had back in September a high, and then in February a lower high, and we're still lower. This doesn't look as bullish, right? Well, I'm going to come back to that one in just a minute. Look at the XLC S&P 500. So this is communication services. This is internet, Google, Netflix, some of those names moving the market higher. Meta, of course, Meta's been strong. But those are all stocks that we're seeing in the XLC, big names that are carrying the market to the upside, putting them on their shoulder and just driving prices higher. And those are the companies that are innovative, that can grow their earnings rapidly. And in a low interest rate environment, you can say, well, we're way off the lows. Sure, we are from 2020, but those are lows we never had seen before ever. 3.7%, even 4%, 5%. Historically, those are low rates. If you've got growth stocks that are innovative, continually churning higher and higher profits out, and you're in a historically low interest rate environment, those stocks are worth a lot of money. And then what the stock market is telling me is that it's seeing higher profits ahead for these companies. You can argue with it if you want and say, no, we're going into a recession. That's what the media is telling us. That is not what the charts are telling us. That's the difference. You want to listen to the media? Go ahead. I'm listening to the charts. Now let's get back to that XLY, XLP. What's going on? Or XLY, S&P 500. What's going on here? Why is consumer discretionary not leading? Well, I'll give you one word. Gaps. This takes into account everything that's been happening. The XLY versus the S&P 500. And if you looked at the XLY versus the XLP, consumer discretionary versus consumer staples, you'd see a very similar picture. Down, bounce into early February, and then we've been going lower, and now we're starting to turn back up, but we're still way below this low. If you want me to, I'll show you what this looks like. Very similar. There's your XLY, XLP. Down, bounce, down. Now we're recovering. But we still have the high here, the lower high, the lower high. So it's not showing sustainability, right? Well, One of the things we do at Earnings Beats is a lot of research under the surface. And I'm a firm believer that the stock market Wall Street's been manipulating all of us since probably about May of last year. There was outright selling from January to May of last year. There was no denying it. Throughout all parts of the day, we saw some manipulation moving into defensive areas before it ever began at the end of 2021. Remember, December 2021, all the defensive groups crushed it. And the aggressive groups were getting killed on a relative basis. And then the cyclical bear market happened after that. And we saw selling all day long for 5 months. We were very bearish back then. Some of you think I'm a permabull. You need to go do some history and search the past. There was nobody more bearish than I was to start 2022. And it was the right call. But that selling from January to May was completely different than the selling from May through October. And I've pointed out, some don't want to listen, that's fine. But when you look at the XLY, XLP right here, I'm going to show you what happens if you strip out the gaps. The gaps are just news. Market makers decide where the market's going to open, scares the pants off everybody because the market's going lower at the open. So everybody sells. Here we go again to the downside. And if you haven't been following the pattern of what's been happening for the last almost year, it's been the same pattern. Gap downs, morning selling, afternoon buying. And so let's strip out the gaps. And what does this XLY, XLP ratio look like? This is what it looks like. Little different picture. Saw some selling intraday back at the end of the year. That was back when financials and industrials were doing their thing. They were leading the market. Technology, communication services, and discretionary were not. They were weak in November and December, which is somewhat of a seasonal thing as well. But since the beginning of the year, look at the XLY, XLP. Do you see any big drop after February? I see sideways consolidation. I actually see a new high here in March. If we go back to that chart I was just showing you, what was going on in March? Here's March. Yeah, we were just continuing to go lower, driven lower by gaps, because this ignores gaps. And we were actually at a new high by the end of March. And look at where we are now. What do you see as you look back? I mean, I'm seeing a chart that's moving higher, not this one, which has been moving lower. So you want to follow the news and you want to follow the gaps and you want to follow all that? Be my guest. I'm going to follow where the money is actually going. I'm going to follow the charts and what is actually happening throughout the trading day, which is buying of the XLY. One other chart I'll show you before we move on here. And I don't have a whole lot more today, by the way. But one other chart I wanted to show you. This is an argument a lot of folks have about why the market can't go up. Small caps. What about small caps? Small caps are horrible, right? Well, they are. But if you look at the relative strength of small caps, they don't really lead the market higher. Their long-term relative strength versus the S&P 500 throughout this bull market has not been anything to write home about. But let me show you something here on the small caps that I also recently, through research, just checking on things, stumbled upon. There we go. So let's look at small caps up here. Okay, we're going lower. And let's look at what growth is doing versus value. So in this year, you can see we've had growth killing value to the upside. Now, the overall small cap stocks are going down, but ask yourself a question. Why is money rotating into growth in small caps if we're heading into a recession? I'm not going to pull up mid caps, but it's the same picture. Mid caps going down, mid caps growth versus value going straight up. And of course, large cap growth is carrying the market, and that's all everybody's talking about. Yeah, it's just a handful of companies. No, it's not a handful of companies. It's mostly all growth companies, because all the money that went into value in the fourth quarter, that's where you made money. You needed to be in value. S&P crushed the NASDAQ in the fourth quarter. What we're seeing this year is all that money rotating back. Everything's moving back from value into growth. Why? Because a recession's coming. How dumb does that sound? Again, maybe we're heading for a recession. I don't know. But I'm following the charts, and the charts are telling me to buy, and that's bottom line. NASDAQ 100, I just wanted to point out here the breakout above that August high. So the S&P, remember, 4305, we got to get past that level to turn that weekly chart around. Look at the weekly chart on the NASDAQ 100. Lower low, lower high, lower low, lower high, lower low. Oops. We took out that lower high. This series of lower highs and lower lows, which is the definition of a downtrend, just ended last week. There's your confirmation. So now this is where the technicians say, okay, it's time to get back in. We were, 3,000 points lower when the market bottomed. And now we're just going to start getting back in. This is why, for me, I love following technical analysis when we're in uptrends and when we're in downtrends. The problem is these are late to the party in calling tops and bottoms. They're lagging. Now we're getting a breakout. Everybody's still looking at 4,300 level on the S&P. Well, when we break it, guess what? We'll be up 800 points since the bottom, and only 500 points from a new all-time high. It just doesn't seem right that now's the time to start getting back in. I mean, I guess if you're out, yes, it is. I think the market's going to go higher. But why not follow the signals that give us advance notice? Why wait for the lagging indicators? Anyway, that's my rant for today. Let's see what the market's doing. We did just get an open. Right now, Dow down 22, S&P up 1, NASDAQ up 6. Not really much going on. VIX still hanging down around 17, up slightly this morning. Small caps, mid caps, both performing a little bit better. And I actually think with the growth leading in small and mid caps, I think that's a precursor to these groups going higher. I don't know why anyone would be moving money, why Wall Street would be moving into the growth areas of these two asset classes if we're worried about a recession and if prices are going to end up going lower. Growth stocks will get killed. So why is growth stock leading? Why is it crushing value in both growth or small cap and mid cap right now? Why? Ask yourself. Because of a recession? I don't think so. Anyway, that's it for me. Tomorrow I'll be back over at Stock Charts TV for your next Trading Places Live. I do want to mention for members, our Earnings Beats members, our EB Weekly Portfolio Report. I almost always get that out on Sunday. I usually try to do it in the afternoon, early afternoon. It was delayed this weekend. I'm going to apologize on a personal basis. It was my birthday weekend. Had golf all day on Saturday. Sunday was a little hectic as well. And so I wasn't able to get to everything. But I'll have it out this morning to everybody. So if you're waiting on that, I'll have it out by noon today at the latest. So that's it for us today here at Earnings Beats. Thank you for listening in. Spread the word on our live streaming feed on YouTube to all your friends. Make sure they know about us. Bring them all in. Like the video and subscribe to our channel. Make sure you know everything's going on over at Earnings Beats. Take care, everybody. See you tomorrow over at Stock Charts TV. Happy trading.
Hello. Thanks for watching the video. If you enjoyed this content, please consider liking and subscribing to our channel. If you want notifications pushed to your phone anytime we post a new video or we go live, please click the bell next to the subscribe button also. Thanks.